Hello, chart watchers, and welcome to this Tuesday, July 9th, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, market got off to a little bit of a rough start. It is trying to battle back, though. Currently, we have the Dow Jones Industrial Average down 94 points. The S&P 500 down a little under 3 points. The NASDAQ has actually turned positive, now up 20.5 points. And the Russell 2000 still lagging a bit, down 5 points. 10-year Treasury yield trying to get through the 20-day moving average for the first time in about 10 weeks. We'll see whether or not we can close there later today. Volatility index was on the rise earlier today, but it has reversed off of that earlier high, which was up closer to 15, and we are back down closer to the 14 level now. Communication services having a strong day along with real estate. However, on the other side of the coin, we've got materials and staples leading the market to the downside. Did want to mention, some of the stronger industry groups in consumer discretionary. Broadline retailers, you can see having another strong day. Specialty retailers also having a strong day. Whereas on the flip side, the weak continue to get weaker. The recreational products group having a very, very rough last 5 or 6 days, extending those losses today down more than 2%. PepsiCo in the news today. We did get an earnings report out. They beat on their top and bottom line, and the reward is they're down about 1%. 3M gets a downgrade. Stock's been really an awful performer. We've been talking about that one recently here on Market Watchers Live, and it is down another 2.5% on a downgrade. All right, Erin, first of all, how are you doing today?
I'm doing quite well. It's a beautiful day here in Seattle.
Yeah, and we've got a special day today because you have somebody joining you and joining us today. We have Mary Ellen and Erin. How are you doing, Mary Ellen?
I'm doing well also. Yes, up here in Seattle with Erin, and it's wonderful.
Yeah, and we've got the whole Market Watchers team together. This is pretty exciting.
Woo-hoo. Exactly. You're now you now are kind of the odd man out, if you want to call that. Man.
Yeah, you're double teamed. How about that?
Yeah, no pun intended. But I'm the odd man out. Is that what you're saying?
Exactly.
Well, I tell you what, this is going to be an exciting show. It's always fun to, get multiple folks together so that we can talk about some things. We got a great lineup slated here today on the show. I know we're going to talk a little bit later to both of you about your new show. I'm really excited about that. I kind of joke that it's our Market Watchers Live spinoff. But all kidding aside, I am really excited. I think it's a great show and great opportunity. So congratulations to you both. But we'll talk about that more in a couple minutes. Erin, what do we got going for today?
All right, let's take a look. Upcoming schedule. Tony Dwyer is going to be with us on Wednesday. Greg Schnell is coming in on Thursday. Martin Pring, we're going to see him the following Wednesday. And then that'll be followed by Mr. RRG, Julius de Kempener. And then we will be doing in another 2 weeks, Relative Strength Week. So it'll be a special time. We're going to really focus on that in that particular week. But today we are going to start off with talking about our new show, Chartwise Women, and some of the different traits between men and women. Then we will look into sector rotation, what's been going on there. 10 and 10, our first symbol will be QDEL. QDEL, and Sound Off is going to finish off the show. So get ready, Mary Ellen. We're going to be cut off a few times, I think, at the end.
Well, I don't know. I'll try to be nice. Actually, I have no control over it, so it doesn't matter how nice I am.
Yes, our producer's like, that's right.
Yeah, probably shaking her head right now.
All right. Technical news and headlines. Let's get it going.
All right. Well, there wasn't anything in terms of economic news, but we'll take a quick look at the 10-year Treasury yield. And this is what I was referring to here. You can look back. It was early May was the last time we closed above the 20-day moving average on that TNX. And the other thing to keep in mind, too, is we have not had the 20-day moving average above the 50-day moving average since all the way back in November. And there's a big spread here. Talked about the positive divergence. Yield's been going lower. PPO's been turning higher, and how a lot of times that will lead to not just a 20-day test, but a possible 50-day test. So I'm looking for the yield to move up a little bit. We did have a strong jobs report last Friday. I think there are a lot of market participants that wanted a 50-point basis cut by the Fed later this month. I think it's probably going to be 25. I do think we'll get one. I think that's what the market is looking for and expecting, and I think the Fed will deliver. But I don't know about that 50. I think that's a little up in the air, especially after that jobs report. As far as earnings reports out today, we haven't really talked too much about earnings because there haven't really been a whole lot of earnings. But this morning we did get Pepsi out. Pepsi had a pretty nice report there. You can see bottom line 154 versus 149. Their top line actually was pretty strong as well. They did come in a little bit above expectations. Wasn't a huge beat, but a beat is a beat. 16.45 billion. Market was expecting 16.44 billion. They guided in line, and I think overall, not a bad reaction. I mean, we are down a little bit today, as I noted at the open, but I think there was a lot of good news already built into this report. PepsiCo has been trending higher. We had a breakout in early June. I think this just is adding to the consolidation. I suspect if we get back down to 130, it's going to be a good opportunity in Pepsi. We got another dollar and roughly $1.33 to go there. But here you can see that Pepsi relative to the soft drink group put in its relative high back in April, has pulled back a little bit, but still overall the group's doing better. And like I said, sometimes when you get into these stocks that are consolidating, you tend to see a little relative weakness. I would not give up on Pepsi here. I think Pepsi, like I said, holds that 130 level. A couple of other areas that I mentioned at the top of the show, and I want to just go over those briefly on a relative basis. So at the open, I talked about broadline retail doing well, specialty retail doing well, and then the recreational products not doing so well. And it's really just a continuation of what we've been seeing. So here's the broadline retail group relative to the S&P 500. So not only is the group going up, but because the S&P is down, you can see that the relative strength is building here again in broadline retailers. Not far from a new relative high, and I think that's really important to keep in mind. Same holds true for the specialty retailers. We're getting that relative strength, and look at this potential breakout in terms of relative strength. You want to be with those relative leaders, and both broadline retail and specialty retail are showing us some strength right now. How about recreational products? I talked about them not performing well today. Well, if you look back over the last 18, 19 months, this has been the norm. This is what this group has been doing. It's been underperforming, and it's simply adding to it. These are the types of areas of the market that I personally want to try to avoid. I think it's very difficult to pick out a recreational products company and have it outperform the S&P 500 when the overall group continues to move lower. So that's just something to keep in mind. One announcement out earlier, we did have PJC, which is Piper Jaffray. They came out with an announcement that they were acquiring 100% of Sandler O'Neill for $485 million, most of that in cash. Not really a big reaction in the market, though. You can see this is a stock that doesn't trade a lot. Just wanted to point it out because it was in the news. A bigger acquisition was Cisco acquiring Acacia, ACIA, for $26 billion in cash. Really nice looking chart here. Hasn't gotten the breakout yet, but has been performing really well. Look at that false breakout off of this uptrend. You got that almost like a reverse hammer, which showed that failure. We came back down over the next week or so, tested short-term price support. Now back up we go. We'll see whether or not we get the breakout there on Cisco. ADS was in the news. Their board approved a 1.1 billion share repurchase program, $1.1 billion. They needed a lift, and maybe news was out. The stock was starting to rise before the announcement. But if we go over here to a relative chart, I think you will once again see how important relative strength is. So this is in the financial administration group. Financial administration has been awesome. On a relative basis, it's been one of the leaders. And yet, look at this stock, ADS, relative to its peers and relative to the S&P 500. So it's been really rough go. I'm not a fan. I mean, we're starting to show some nice movement here to the upside, but because of that long-term relative weakness, I would rather find something else. But I do want to point it out for those of you maybe who are more value-oriented rather than momentum-oriented. This might be a type of stock you might find some interest in, especially with the board coming out announcing the $1.1 billion share repurchase program. The dollar, US dollar, kind of quietly, I don't need this chart. Let me go over to a different chart here, but quietly making a move back to the upside here. You can see 7 of the last 9 trading sessions, we have seen a gain in the dollar. The dollar had been under a lot of pressure for about 3-4 weeks, the end of May, throughout most of June, but it is beginning to bounce back. So far, it's held those prior lows. If we look at what's going on today in the dollar, you can see the UUP is up again, testing this recent high. So if we look at the USD, go back to that, we can assume that we're probably going to be up somewhere around the 97.25 area today. And that is putting some pressure on the materials. I mentioned materials down today. Look at it losing the 20-day moving average. All of a sudden, this renewed strength in the dollar starting to have an impact here. And I think that's important again, because we have seen for a long time the relative weakness in materials. I'm going to go back here the last 10 years on a weekly chart and pull this up. And this is what the group has been facing. And when we look at this and then compare it to the dollar, check out what the dollar's been doing during this entire downtrend. The dollar has been rising. And so with the dollar moving back up again over the last week or two, that's been one of the reasons why we're seeing that materials group rolling back over again. We'll talk about materials and the dollar a little bit later in the show. All right, let's go back to the main page here, because I wanted to pull up the scooter that I wanted to feature today, MTSI. You can kind of see in that little mini chart, see that little breakout? But it's risen 22 points today. I just want to point out that this 16 area, we have not had a close above 16 on MTSI in, well, the last 3 months or so. And if we pull this up on a relative chart, it's in the semi space, and we're seeing the last 2 months relative strength. Now, this is a stock that's been moving down on a relative basis for the last year. So if we don't get the breakout or we get this failed move to the upside, you want to be careful. But in addition to starting to see some relative strength, look at the volume trends starting to show much more bullishness. And today's move above 16 is occurring with heavy volume. So I think MTSI is a really interesting chart here. It is breaking out. It's one of the top scooter movers today. And so for these reasons, it is your scooter mover of the day.
All right. It is time for some upgrades and downgrades. Really slim pickings there as far as the upgrades go, but interesting ones nonetheless. First one up is Six Flags. Wells Fargo upgraded it from a market perform to an outperform, and they have raised their target from $52, which is down here where we have that 50-day EMA positive crossover, and they have raised their target to $56. So we're looking right about here. Let's go ahead and we'll add some, there we go. Let's add some trend lines here so we can see what's going on. So there we're looking about 56 is the upside target. And let me get this to be horizontal. That makes it easier. And then here, of course, is your short-term support right there at about 48.30. And the overhead resistance, I would go to the tops that we're seeing back here, and that's at about 54.32. So right now you can see it's been in a little bit of a downtrend, but it does want to pop a little bit here. It is up, let's see, 1.41% on the day. So making a move on that upgrade. Next one up I want to look at is Square. And we were talking about this before the show started. I know Mary Ellen and Tom are really excited to see this one moving. And you can see we've got a beautiful move today, up over 5.6%. Let's look at some of that overhead resistance. I would put that right here at about $83. You can see it matches up with that top we had back here in November. And then we've got the top that we had back here in late February. So that's where I would be looking for this to travel. Look at that nice breakout though in the short term over those two tops. Honestly, if I'd looked at this chart yesterday, I would maybe be a little bit concerned of a little short-term double top forming here, but not the case. And you can see the PMO is continuing to fly upward, and look at the confirmation on this move by the OBV. So like the looks of this, it does make sense on that upgrade. All right, next one up is Vion Limited, and quite the rally that we've had here after this breakout from Truly. This is just about as textbook as you can get as far as a flag formation. So let's go ahead and mark that up there. I mean, look at that. That's very nice. So flag formations, of course, are bullish, and the upside target is the length of the flagpole. So we're looking here at a really nice possibility as far as an upside target goes. So getting that great rally breakout, I would look for higher prices to continue, but watch that PMO. If we start to see it decelerate and maybe start topping out a little bit, that would probably be the time that we might get a little bit of consolidation or maybe even a pullback. So I did not get a target for Vion. They did not, B of A Merrill did not give us one. All right, let's look at the downgrades, and there was such a long list. I only am going to go over 3, but I will have the rest of them on our summary slide, so you can take a peek at those on your own later. I'm going to get the horizontal line here set up on our ACP. There is your short-term support. You can see that on this downgrade, we gapped down right there. And overhead resistance in the short term, you've got both the 50-day EMA set up here, but you can see that overhead resistance lined up with those lows that we saw back here in May, at the end of May. Let's go ahead and look at this a little, we'll bring it out just a bit. This is a stock that's really been on decline, of course, since last April. I'm sorry, April of last year. Really quite the underperformer. So, it's not a surprise to see that downgrade coming in at the lows that we got here and the failure to get above that overhead resistance. So now we're starting to test the lows down here at about $21. You can see that PMO had started to turn over, and it turned over below the 0 line. So this one makes complete sense, in my opinion, as far as a downgrade. Next one is Cadence. It was downgraded today by Stevens from overweight to equal weight. And the target now is $23. So we're looking right about here. You can raise that up there. Yep. They are looking at a target of that overhead resistance area back here from May. Looks like April and May. Short-term overhead resistance, of course, right here at that top earlier. And look at the support holding right now. The PMO is still above the 0 line, albeit barely. And it has slowed down. But I'd watch this. It is a downgrade, but it's now testing some pretty important support. You could probably look at this maybe for a move back up. But if you look right here, and let's get the, let's see. I'll just do a trend line here. You can see right here, let's get it right there and right there, possible double top. So now we're getting the double top, and now the expectation would be the breakdown, and where would be our support level. Of course, we put it right about here at about 1850. So I would be looking for that decline. But like I said, keep an eye on that PMO. Maybe we might get another test back up here at overhead resistance. But again, when you're looking at a stock that's being downgraded, I can see the 20-day EMA has gone below the 50. There are certainly better investments out there, but I think that, they did move it to an equal weight rather than an underweight. Marriott was downgraded today, and also Hilton by JP Morgan. I'm not going to look at the Hilton chart, but we'll look at this Marriott chart. It was downgraded from an overweight to a neutral. So again, we're going into that neutral position, not really a sell position. And it looks like their overhead, their target, they now have at 138. So it's really testing that area right now. And, of course, the expectation on the downgrade would be that it will break down. And where would be your next area of support? Honestly, I'd go all the way back here to the top that we saw back in February. So expectation to me would be that drop down to about to that to about 129.25. I think that would be your downside target here. If you want it, you could look here also for some support in the short term on that 20-day EMA. We're getting ready to test that. So, if I bring this out, Marriott has been a pretty good performer since the end of May. Nice move to that upside, but we're failing. And if we go back in time, look at where that lines up. I've got that horizontal. That was our top back there in January. And now we're looking at a failure to even go and test that area. Looks like it failed right here at those tops we saw previously. PMO is turning down. It is time maybe for that pullback. This would be the worry I would have had earlier on, the failure to get up here and at least test that longer term overhead resistance. That's all I have for the upgrades and downgrades. And like I said, not too many upgrades. But we will be right back with a great discussion about the Chartwise Women premiere. So stay tuned.
StockCharts is unique because we combine the commentary, the education, as well as the tools in which you need in order to analyze the markets.
The human component around it with all the commentators that we have. I mean, look at the lineup with Murphy and Pring and Morris. These are household names in the industry. They're all tied to StockCharts.
People are always surprised with how many tools are on there that they didn't know about. 5 or 6 different methods for finding relative strength as an example.
Not only do we have these really great chart tools, but we have this amazing chart school, and you have these shows, and you have all these ways that you can learn.
Okay, welcome back, everybody. Last week, we aired the premiere of Chartwise Women, and it featured MarketWatchers Live's very own Erin Swinland and Mary Ellen McGonigal, and I have both of them here with me. I know that there was a lot of positive feedback for the show, but Erin, how do you feel it went from your perspective? How'd that first show go?
Oh, it was fabulous. Mary Ellen and I think, do have quite the chemistry. We're friends outside of work. We do both live in Southern California, so we have that opportunity to really be conversational. And that is what we really wanted to go with on our first show. We do show charts, of course. It's Chartwise Women. But I thought the first show went really well. It's a little bit more come into our living room sort of thing, into our trading room, like Alex Elder talks about. And, we covered quite a lot of topics in that short half hour, but it was a lot of fun. We had a lot of different interesting segments. And honestly, I think one of my favorite segments was at the end, where we do a thing called, Yeah, That Happened. And we talked about the pop-up hotel that Taco Bell had come up with, and then we looked at their chart. So it was a pretty interesting show, I think.
Yeah, I tell you, if there was any fast food place out there that I'd go to for maybe to stay overnight, might be Taco Bell.
I'm more of a Del Taco fan, actually, but
Yeah, I like Taco Bell. But anyway, Mary Ellen, I know Erin kind of hinted a little bit at the topics. What else? What other areas did you cover on your show?
Well, we did review the different trading styles between men and women. I think we'll be getting a little bit into that today as well. And there are some striking differences that really make a difference over the long term. So we did review that. There's another segment, and we talked about what's cooking, and it was from the data farm to the table. And we reviewed areas that were currently outpacing the broader markets. And then within there, we had select stocks. So that is something we'll be reviewing over time. But it's all with an eye toward educating, but also simplifying the process so that it is more approachable, primarily for women, but also men as well. So we're going to be putting some systems in place that we're going to share with our viewers. So it's all really exciting.
Okay, well, that was going to be one of my questions, is whether or not it was primarily for women, but it sounds like it's really for everyone, maybe with a little bit of a focus towards getting women more engaged.
Well said.
Okay,
Yes,
cool.
Absolutely.
So Erin, if in your words, what is the objective of the show? Obviously you're trying to get them engaged, but what else is out there? What are you trying to do with Chartwise Women?
Well, we have our 3 E's, which you can see up on the chart right there. And, for me, the biggest one, and it's often associated with women, is empowerment. But, we're not talking about woman power here. We're talking about empowering all traders and investors. And, of course, you have to educate. That's where you get your comfort level to trade and do those things that maybe you've handed off to somebody else to do. I mean, typically that's what happens. Women typically let somebody else manage their money. And we want to get away from that and show people that, look, if you're educated, if you want to have, some power over what you're doing, it's really important, because let's face it, who cares about your money more? You do. And so we want to engage people and also make it, like I said, conversational, and bring sort of a comfort level to beginners, as well as, your tech analysts that are a little bit more expert, because I think we're going to give you a couple of different ways to look at the trading and investing.
All right. Well, speaking of traits of women, I've done a lot of webinars and seminars, especially live seminars. And I have to admit that probably 80 to 90% of the audience has been male. There just haven't been a lot of females. It's not because we haven't, advertised or marketed towards women. It's just that I think, as you said, I don't think as many women are as engaged in investing and trading. They tend to maybe put it off for others. The show obviously is going to try and change all that. But if you get into some of the traits, and I have, a couple of my own personal thoughts about that just based on my own experience, but what do the two of you, I mean, obviously you have a much better idea of the traits of a woman, as both of you are women, but what do you think are the key traits that differentiate women from men?
I think, interestingly, during the show, Erin and I realized that we are not typical of the broader female audience, and we are a bit more unadverse to risk, I would say. Most women are risk adverse, and they have statistically more funds in savings than men. And in uncovering the fact that we are inclined, we're not afraid of risk in the broader markets, it came to light that it is primarily because we are financially literate. We do have that knowledge. So that seems to be the big gap, the big divide, if you will, and something that a gap that we're hoping to narrow.
Yeah,
Right.
I know personally, I've seen that in some of the live seminars that I've done. Not so much taking on the less risk, but visualizing the charts is something that I noted. And again, it's just my own perspective based on what I've seen over the years. I've done no studies, and I haven't really followed up with anyone who has done a study. But I did notice that women tended to pick up the visualization of the charts quicker than men, just to be quite honest. And the ability to wait and have the patience, show that patience for, stocks maybe to come back to a key area of support, and not feel like you've got to go rushing in and jump in with both feet and, take a big risk. That seems to be what I've kind of taken away from that. And honestly, doing the shows with both of you, I kind of get that sense from you all as well, that you tend to be a little bit more closer to the vest than certainly I am. I'm a little bit more of a risk taker. Erin, would you agree with that?
I think so. The one of the things, and we have it up there too, women tend to plan and take on less risk, as we're showing there. But I think that women at first, maybe that aren't involved in this sort of thing, maybe at first are a little bit, put off by all those squiggly lines and trying to figure out what everything means and how to calculate everything behind it. And, ultimately, what we've found, and I'm sure you have, is that once you can just see it on the chart, you really don't need to know necessarily the equations behind it. The visuals, looking at those EMAs, looking at just a few particular indicators, momentum, of course, being one of the big ones. I think it's pretty interesting, but I think you are correct. on the visualization. And I think I did a seminar at one of the chart cons for the spouses that were there, just to kind of show them, hey, your spouse is always in there looking at charts. And again, it could be female or male. I had some males there as well. And I wanted to show them that, it looks kind of complicated from afar, but once you dig in just a little bit, not even a whole lot, the light went on. And I even told them some things that they could point out to their spouse to say, well, did you know if you do this, it'll look great. So,
so Mary Ellen, as far, we talked a little bit about patience. And I know, your philosophy a lot of times is to kind of watch that 50-day moving average. I know just from discussing with you, that is a really big thing that you watch for, stocks
right.
above or below.
Mm-hmm.
I mean, how did you initially get into this? And I mean, what was it, I guess, that pointed you toward the 50-day moving average? Is that just something that you experienced?
That's a great question. I spent 15 years with William O'Neill and Company, and it was a lot, of course, technical and fundamental analysis, but that 50-day simple moving average, I guess basically you could say that's how I was schooled, because that moving average has been, you can look at charts over time, just this real, it can be a barrier for the downtrend reversals and then act as support as the stock is in an uptrend. So I've found it to just be super, super powerful. A lot of the work I did while with O'Neill was with institutions, and this is what the institutions pay attention to, and primarily their footprint is what you're going to see out there in the market. So if those institutions are paying attention to that 50-day, that is critical as for the self-directed investor to pay attention to.
Yeah, and it makes sense. I mean, anybody who follows technical analysis, I mean, I don't know too many investors. In fact, I can't think of any that use technical analysis and don't have a moving average on their charts. I mean, moving averages are a big part, and it's a lagging indicator, but it gives you a very good sense. If the moving average is moving up, then the price action is going higher, and if the moving average is going down, price action is moving lower. And if, depending on where the price is, if it's above the moving average, obviously you're still in a uptrend. That's a very simple way of looking at it. And if it's below that moving average, obviously it's not in an uptrend, or it may be reversing that uptrend or something. So that definitely makes sense to me, and is a very, very simple way to quickly visualize whether or not a stock is, looking good or looking bad.
Yeah.
Now, I know everything we do here at StockCharts is based on education. We're trying to do things to help folks manage their own finances and so forth. And I know that is also part of what your show is all about at Chartwise Women. Why don't one of you take a minute to talk about that for a second?
Well, I definitely would say, like I said, I find empowerment to be kind of the main one of our 3 E's. But, you can't feel that way unless you get educated. And, as it's showing on the screen, over time, more and more women are getting involved and educating themselves. Mainly, I mean, there's so many different situations. It could be from being, widowed, to going through that divorce, to getting back in the workforce after having been away from it. And once you get educated, once you go in and start looking at this stuff, and as it says there, Fidelity started offering these education programs sort of focused at women, to sort of draw them in. And it's more and more of us are getting involved, and it's really great because, like you said, I mean, I remember going to the first couple of chart cons, and I was definitely in the minority. And of course, always on the panels, as far as our bloggers and everything, it was just me.
Yeah.
It's the woman. So it's so great to have Mary Ellen coming in. And I know that we've been working a little bit with Danielle Shea. It's just great. And having those mentors, like for me, Linda Raschke reached out to me and, drew me in. She's been in this business forever. And, fellow female and getting started in the business. I mean, she reached out and I learned so much. And it also brought confidence. Education makes you feel more confident in what you're doing.
Yeah, no doubt about it. Well, I do want to mention to everybody that Chartwise Women, which did premiere last Wednesday at 4:30 Eastern, has a new time. So I want to make sure that everyone realizes that it is now at 3 o'clock Eastern, so noon for those of you on the West Coast. And yeah, right there you can see. So Wednesdays, 3 p.m. Eastern. I have to say I'm really excited for both of you. I think it is a little different show, just a little bit different spin. Maybe hopefully a little bit different audience, but as you mentioned, I mean, it's really for both men and women. But it is an opportunity maybe for women to connect a little bit better with with two women that maybe think somewhat like them in terms of taking risks and patience and so forth. So really excited for both of you. Great show, and looking forward to all the great things that you do in the future together.
Thanks. And if y'all missed it last Wednesday, it is on our StockCharts YouTube channel. So go ahead and check it out there.
Absolutely. All right. Well, that is Chartwise Women. We are going to move now into sector rotation. And there's really not a whole lot out there that's more important than where the money is going. I know John Murphy has written a lot about it, the different cycles we go through. We're always comparing here on Market Watchers Live, areas of the market versus other areas and what that means and so forth. So I thought we'd take a little segment here and go through just a quick discussion of sector rotation. And Erin, I don't know if you're ready. You want to start us off?
Absolutely. So right in Chart School, and I'm just going to show you where that link is, you can go in or do the search for sector rotation analysis. And it's not only do we show the business cycle, but this is what we're going to concentrate on today, which is the sector rotation. And we've updated this to include some of the new areas like comm services and real estate. So it's very interesting to see. Here is the economic cycle, and here is sort of the stock market cycle. And based on where you're at, which ones are supposed to lead, depending on where you are. Of course, it's not a perfect system, but typically at those market bottoms, you're getting ready to go into a bull market. That's when you want to see those more aggressive sectors starting to take off. Once you're in it, that's when you want to see the industrials, materials, and energy sort of being pulled up a little bit with that. But then when the market starts to top, notice that the defensive sectors start to become more interesting and where you want to go. So I just wanted to show kind of that basic, the diagram here. But I'm going to go to where you can find. Here we go. If you go to our sector summary, and you can find it in charts and tools over here. But this is a great way to, sort of experience and see firsthand that rotation. And there's so many ways you can look at it. One, of course, is just looking at our sector summary. You can also change the period. So one of the things I was looking at, in the past month, what has been as far as the leaders, and look at what we're seeing by quite a bit. It's these more aggressive sectors that have been leading the charge, and that's what you want to see going into a bull market or a rally. You want to see that continue. And notice on the bottom, your consumer staples, utilities. Of course, in the last month, everybody's been having a pretty good time here, as you can see. But seeing who's leading and who's lagging. If you look in the last week, now we're looking at real estate, energy being near the top. And there's another defensive sectors with utilities. And then down here, you can easily do that perf chart and run it through and see and make those comparisons as to which ones tend to lead and which ones tend to lag when one is doing well. So for example, here you can see looking back, just dragged that slider down, but you can see that at one point in the market we had, as I said, typically they go together, and there you have real estate, utilities, healthcare, and even staples. And then what was lagging during that period? Oh, well, it was comm services and discretionary and technology, all of those more aggressive sectors. So that's why we really pay attention to it.
All right. Well, Mary Ellen, I know you were going to take a look maybe at a weekly view of some of the different sectors. What do you have?
Yeah, I did want to take a look, because what we are seeing here more recently is a continuation, I wouldn't say a shift, but a continuation into these defensive areas of the market. And a lot of times when people see this, they think that the reason is because of the higher yields that these stocks offer. They are viewed as defensive, but I wanted to focus on areas because within these defensive, we're looking at a daily chart of the consumer staple sector. And really what I wanted to do was point out the fact that a lot of these, in this, we'll go into real estate after this, but consumer staples on average yield about 3.3. That is always quite attractive in a broader market that may be a bit more volatile. You're looking to buffer some of that volatility. But I will tell you, within consumer staple, we can see this move here despite a move into growth stocks as well. The reason is a lot of these, let's talk about staples first. There are areas here where there are really very healthy growth prospects. And I'm going to take a look, for instance, here. This is Tyson Foods, TSN. We can see this significant uptrend. We can also take a look at Pilgrim, PPG. There is a whole shift. Let's talk just about food, where this is actually not the right chart. But the fact of the matter is that there has been this move into protein-based foods. So with that come some really significant growth prospects. So it's not really just defensive. This is Pilgrim's Pride, PPC. We can look at any number of stocks within this food space. There are going to be taking advantage of this shift culturally into protein-based Beyond Meat was one of the bigger IPOs in this area. And that stock has been actually a little bit more volatile. But let's take a look at another food stock, and we can really drill down as investors. You can with StockCharts.com by going to that sector summary and then drilling down into the industry group. We're looking here at Hershey. Take a look at this big uptrend. This is a weekly price chart. We can see since January that this area has this particular stock has really outperformed. So what we are seeing, in addition to a shift, there's also a shift among these different companies that are shedding their lagging areas of consumer. They are shifting their product offerings to respond to a shift among their customers. So you are seeing, we can look at PG is Procter & Gamble. They have offer an awful lot to consumers in the way of products that are, maybe it's beauty related. There's a big move into pets, and pet food is a big part of Procter & Gamble's, and we can see this significant uptrend. So the point here is quite simply that when you think of consumer staple, I would urge you to look at it a bit differently, not just as defensive and offering a yield alternative to a lower 10-year treasury, but also as a growth area. And let's just take a look here at the real estate sector. XLRE is the ticker. Again, we're looking at a weekly, and we can see this big significant uptrend that has been occurring. And this is another area where you are going to be presented with a nice significant yield, particularly within or among these REIT stocks. We can take a look at WPC. This is a diversified REIT that offers a significant yield. But I will argue that this particular stock is not just defensive. It's not just the yield, because these companies are growing. We are, albeit not as strong, but there still is an economic expansion in place. So these companies are able to purchase these properties and offer these higher yields. This is MPW, Medical Properties. This is in line with a shift in the as far as the aging population. So there are a number of these medical properties that offer long-term care and so forth. Again, another growing industry. So in addition to a favorable yield environment, you also have those growth prospects.
All right, sounds good. I'm going to take a little different approach to it here. I mean, both of those were excellent. I'm going to look at a long-term picture here for a moment. And this is a chart of the S&P 500 going back 20 years. So, and it's a weekly chart. So you can see all the ups and downs during the secular bear market, and then you can see this huge move in what I believe is a continuing secular bull market. And what I wanted to point out here, looking at these aggressive areas of the market, and down below, I've got technology relative to the S&P 500. When we look at sector rotation, we can look at it as one sector versus another sector, or we can just compare them all to a benchmark like the S&P 500, because the S&P 500 is made up of all these different areas within the market. So I've got the technology group relative to the S&P 500. Then I've got consumer discretionary relative to the S&P 500, communication services, industrials, and then financials. So these are the 5 areas that when you're in a bull market, I feel best when the stock market's going higher and these 5 groups, or some combination of these 5 groups, are leading the push to the upside. So before I get into the current, where we stand right now, I want you to look back at the last bull market we had before the 2007 to 2009 bear market. 2003 to 2007, we had a pretty nice rally. We went from about 800 on the S&P 500 to 16 or almost 1600 5 years later. That's a double. So, when you're in the midst of something like that, you're thinking pretty bullishly. But we never were able to clear that prior high on the S&P 500. And if you looked at the leadership throughout this rally, look at the XLK versus the S&P 500. We never broke out above the high in 2004. Check out consumer discretionary. We never broke out above the high in 2005. Communication services back then was part of technology, so there's nothing there to look at. Industrials were having a pretty good move to the upside. I would say this was the one area that really did well during that last bull market. Financials were doing pretty well heading into the beginning of the bull market. It wasn't really that financials were doing well, it was that the technology area got crushed. So financials on a relative basis looked pretty good. Then we started to show some relative strength in 2006, but before the S&P 500 topped, the top was in October 2007. Before we got there, look at what was going on here with the financial group on a relative basis. It was already falling apart before we broke to a multi-year low on financials relative strength, even before the S&P 500 topped. So we didn't have really any area other than industrials among the aggressive groups that supported that bull market. And look at what we're looking at now. And I think you can see a little bit of the difference between a secular bull market and a cyclical bull market within a secular bear market. Here is what technology has been doing over the last several years, really over the last 6-7 years. And look at consumer discretionary ever since that bottom back at the end of 2008. Beautiful move up. Communication services. I don't think there's any question. There's your industrials. The one group that has struggled the most, but still is moving higher, is the financial group. But you've got all of the aggressive areas of the market outperforming the S&P 500 as we move higher. Until that changes, I'm going to probably remain pretty bullish the overall market. Now, let's take a look at the other side, which are the defensive groups. Same 20-year chart on the S&P 500. And I know that there has been some rotation into some of the defensive areas, especially over the last year or two. But keep in mind that we topped here and we've gone mostly sideways for the last year or two. This hasn't been an explosion of a bull market. You might say so since the end of December 2018. But if you look back over the last 18 months, we essentially have had moves to the upside, downside, and really just slightly higher prices from where we were at the beginning of 2018. During this period, you can see staples did top back in 2016. Same thing for real estate. Same thing for utilities and healthcare, equal highs here. Now, some of these groups have strengthened in the past 18 months, but again, that's normally what you see when the stock market consolidates. When you see the consolidation 2015 to 2016, look at what consumer staples did. Look at what real estate did. Look at what utilities did. These groups tend to do better when the market is not performing well. When the market is performing well, that's when we tend to see either downward movement in relative strength or sideways consolidation. Another factor to consider in the performance of these defensive stocks and the aggressive stocks, to be honest, is that materials and energy during this bull market are getting killed on a relative basis. So with the dollar rising, both energy and materials have been weaker than the S&P 500, and that leaves additional money to outperform amongst the aggressive and defensive areas. So until materials and energy get going, I actually think you could have pretty decent performance in the defensive areas, but I think your best performance is going to continue to be in these aggressive areas. So when I talk about the strength of the market and how high I believe it's going to go, and I do think we're going to go a lot higher over the next couple of years, it's mostly because of the way the market is acting. It's not because I'm just hoping that we go higher. It's because market participants are willing to take the risk. And when they do that, that is normally a great sign of a sustainable bull market. So that's kind of my take currently on sector rotation, which I think was just a little bit different than Erin's and Mary Ellen's. But there you have our summary. And now we are going to go into the 10 in 10. You have an RRG?
Oh, you betcha. Here we go. Let's take a peek. And interesting, we finally have moved back, Tom, into lots of technology requests. Software clearly being the area that everybody is interested in today. As far as what we're seeing on the chart, we do have some outliers. So I'm just going to zoom in just a little bit here. What we like to look for on these RRGs are those northeast flyers. That's the direction you want to see them going on the RRG. That means they're moving into improving or leading. They're moving in that right direction. So I'll try and pick a few of those as well. And we can go ahead and get started with QDEL.
Yeah, some of those RRG charts are pretty impressive because they're so far to the right of that 100. I mean, that's just telling you they've just had tremendous strength, relative strength way out there. Roku, Shopify, some of those names, you can see it pretty clearly visually looking at an RRG chart for sure.
Mm-hmm.
All right, let's take a look. QDEL. Don't like it. Relative strength is poor, and it's in a group that really hasn't been that bad. Medical supplies has been improving since the April low. We did just get close to a 52-week relative high on the medical supplies group about a month ago. We've pulled back a little bit from that. But overall, you can see the reason we've pulled back is that we haven't broken to new highs where the S&P 500 has. But I don't see anything negative. I still see an uptrend here. But the problem I have is that this stock has been a very, very big laggard in terms of medical supplies companies and versus the S&P 500. We had the big gap down here in the second week of May. I highlighted a couple of areas here. After the gap down, you can see we came up and closed just above 60. And we had an intraday high around 62.5. That's where the sellers came back in, and they came back in with volume. So I think you have to respect that area. Notice each of the last 3 times this stock has tried to move up. It's run into resistance at the lower end of this range, right near $60. So I just think there are better stocks out there in this group. I think it's a hold at best. For me, as a momentum trader, I don't really see the strength in this stock. So I would look for another medical supplies company.
All right, sounds good. And the most popular in the chat room, and I'm not surprised to see that, is Roku.
Yeah, I love Roku. I own it. I've talked about Roku quite a bit. I think this one's going to break out again. We might just be putting in the right side of a cup. So let me just annotate that. Nope, that is not what I wanted. Let me annotate this cup. Now, in order to have a cup with handle, which is a bullish continuation pattern, you have to have a prior trend in play, prior uptrend. So I think clearly we have that right here. And we haven't finished this potential cup, and we may or may not actually, have a cup with handle. We may not even have a handle. Maybe it just breaks out. But I do think when you're looking at these types of patterns, anytime I see a stock that's uptrending and it pulls back, I begin to look for continuation patterns, because this has been one of the best stocks in the market. The last 2-3 months, this thing has been really on fire, not only relative to its computer hardware peers, but versus the S&P 500 in general. It did pull back. We got down to the 50-day. This doesn't show it, but on the most recent highs there in in June, these highs, we had a negative divergence on the PPO. So I would have been expecting a trip back below the 20-day. And I think even on MarketWatchers Live, I think I had talked about this maybe a few weeks ago and said if it didn't hold the 20-day, I thought maybe it could go all the way back down to that 50-day. It did. It literally went almost right down to it. And this was the day it was downgraded, by the way. I don't trust some of these analysts as far as I could throw them. And, and the reason I say that is I'm not trying to be mean, but you have these investment firms that have part of their business is to tell clients, to buy or sell. And then they have a market making wing that's actually doing the opposite of what folks are doing with their trades. So, and I'm not saying that there was anything going on here that was wrong. I don't have any information, but it could have been that one part of the firm was saying downgrade and another part of the firm was buying, was providing liquidity when everyone was selling that day. Again, not sure, but I just think that this is something to keep in mind in your trading. But I see what could be a cup here. I would be looking maybe for about a 107, 108 short-term target. If it gets through that level, the volume continues to be very strong. I do think Roku goes higher from here. I like it. And I think a lot of what's going on here is in anticipation of a very strong earnings report to come in probably a month or so.
All right, let's see. The next one up is going to be Gardner Denver Holdings, GDI.
Yeah, I really like this one. It is pulling back today, but I'm going to watch this 33 level. There's really two levels on this chart that I would be watching for on a pullback. There's one, and then the top of gap supports the other. So if it goes below 33 and closes below 33, I think you're going to see 31. If there is one problem with the stock, and you can see the relative strength versus its industrial machinery peers has been pretty strong. While it consolidates, it's pulled back versus its peers. The problem is that the peers, look at the relative weakness here in industrial machinery. I don't think this is a GDI problem as much as it is an industrial machinery problem. Look at the volume that came in. I think that there's a lot of folks getting into GDI. I like the stock. And if we get a bounce back up in this group, back toward the high that we saw in May, I think you're going to see leadership from GDI. So this is a tough one because I think we are getting close to price support around 33. But I would either use these two levels to buy, or I would just watch that 33 level very closely. If it breaks down below it, get out, and you can always get back in if it tests 31.
All right, let's see. The next one is an ETF for solar, TAN, T-A-N.
Yeah, renewable energy has been the best performing group in 2019. And I don't really think any other group has been that close. So this is an area that you definitely should be interested in. Now, whether or not you actually have whether I would buy it at this point, probably not. If I wasn't already in it, I think it's stretched. But one thing that you will notice is that throughout this uptrend, when we get back down to test these moving averages, we've talked about this on the show. There's that 50-day moving average that Mary Ellen likes to follow. A couple of little fake outs to the downside, and then right back up above that 50. But a lot of times when you're in an uptrend, you see these 20-day tests, or somebody who's a little bit more short-term might look at, say, the 10-day moving average. But I would be watching short-term, a pullback maybe to test that rising 20-day moving average. I think that is worth noting. Also worth noting is, and I don't usually pay attention to volume on ETFs, but it does indicate at least that there's a lot of interest here in the renewable space. So I like TAN. I think I just have to wait on a pullback.
All right, this is one I don't think we've reviewed. It is Tech Target in the publishing area of comm services, and it's TTGT.
All right. Yeah, big gap up back in May, and I think right now we're just simply consolidating. I think that $22 area is incredibly important, not just from the gap up that failed in May, and you can see right here 22, but look over here. Big volume gap up. We failed at this 22 level and then kept going lower. Now we're starting to trend higher. Volume trends are much better. I'd look for a breakout here. I think a breakout above 22 would be bullish.
All right, let's see. Let's move on to QD. And this is a specialty finance.
All right, well, I love the space. And it's pretty obvious to see that this is a really nice chart as well. Let me pull it up on a relative chart. All right, so there's your specialty finance group. And here is the stock relative to the group. And it looks like it is really on a roll here, trying to make a breakout. Look at all that volume coming in. Yeah, I would have a really hard time not liking this stock. If we fail to get the breakout today, maybe short term, you see a little bit of a pullback. That's the breakout I'm looking for. So if you leave a tail up near $9 and come back down and close below, say, 875, then maybe it sets up for one more test at the 20-day moving average. But this is a stock that certainly looks like it wants to go higher to me. I like this one.
All right, the next one up is CDNA, Care DX Incorporated.
Yeah, this one's on my strong earnings chart list and is one that I've kept an eye on, waiting for a potential breakout. Another one with good volume trends. The overall group, healthcare providers, has not been that good, but look at the stock relative to the group. You're getting one of the best stocks in the healthcare provider space. Good volume. I just think right now I wouldn't want to jump in because I'm right up against or getting close to resistance. So I think it's just a simple reward to risk kind of a equation. So I think I'd have to see us get through that 40 level, or maybe this pullback. We've been holding around 34. That was prior resistance. I just think 34 to 40 is the trading range for now. And if you get in at 38, you got $2 upside and $4 downside. So it just doesn't make sense for a short-term trade for me just yet, but I do like the stock and I would keep it on a watch list.
All right, the next one, full disclosure, I do own. It's the best thing I have in my portfolio right now, and it's Alteryx AYX. I am loving it. The PMO took a turn to the upside back in early June, and boom, baby, I've been riding this one and continue to plan on it.
Yeah, I could not disagree with you on this one at all. I would absolutely continue holding on to it. I think that, first of all, and you could almost make a living over the last couple of years just trading various software stocks. Software continues to be extremely solid, and I think that bodes well. But here, I mean, you can just see this is exactly what I like to look for in a stock to own. And then if you needed one more thing to beat you over the head, it's all of these volume bars. I mean, on the way up, there's so much accumulation taking place. So you got a great group, probably one of the best areas outside of maybe renewable energy. And I'd make an argument software has been more consistent than renewable energy. So I could make an argument that this is the best area of the market, and you've got one of the best stocks here, Erin. So I think it's been a great investment. Congratulations, and I'd keep holding.
Yes, that they aren't always that way, but boy, every now and then you catch one, and it is a nice ride. But I might be doing a trailing stop here soon. I want to make sure I can book a lot of those profits too. All right, the next one, it is software as well, but you're going to see a big difference on this chart. Salesforce, CRM.
Yeah, I remember talking about this one a while ago. I don't like it. And it's, this was right before its earnings. I think I talked about it late May. It went down, came back up shortly, with earnings, and then went right back down. I think it kind of, I don't know, maybe suckered a lot of folks in on that move back to the upside. I didn't trust it. And the reason I didn't trust it is this. If you did get in, and this is a lesson, I'm not trying again to be mean. If you're in a stock and it's not performing well relative to the group and it begins to roll back over, I think you want to be out of it. Software has been exploding since the beginning of June. And this stock literally since the second day of June has been relatively flat, maybe up $1. Look at the volume, the big red volume bars to the downside. I think distribution's taking place, a lot of folks bailing on it. I don't know the fundamentals going on behind the company, but I don't think this is a stock that I would want to be in. I think there are way too many software stocks out there for me to try and hope that we're going to have a relative bottom sometime soon in a stock like Salesforce.com. So I'd pass on it.
All right. In that technology sector, we're going to look at Adesto Technologies. It's a semiconductor company, and it is IOTS.
All right, you're going to have a relative leader. This is one, again, I've talked about a few semiconductor stocks that have shown a lot of relative strength. This one I'm not as familiar with, but it certainly, lives up to that relative strength hype. Look at the stock relative to its semiconductor peers. And now that we're starting to get some strength in the group here on the uptrend, I think this one's going to go higher. Now, as far as to the downside, your breakout level, right about there. We never even got back down to test the breakout. More recently, to give you a little closer support level, double, triple bottom right here around just under 775, and that 50-day moving average coming in at 764. I think that would be an area I'd watch very closely, but this is a relative leader. I'd stick with it.
All right, that does complete the 10 and 10, and here are the symbols that Tom just annotated. Just go to the Articles tab, click on the MarketWatchers live blog, and the link to this live chart list with those exact same charts is right there at the top. All right, I'll be back with the final market update after this.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Chicago, July 21st through 23rd, dozens of the most respected traders in the world, including Rick Santelli, John Najarian, Tom Sosnoff, Linda Rashke, and Ralph Acampora, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, commodities, forex, futures, and cryptocurrencies. Claim your free pass to join them at chicagotradersexpo.com.
Right, it is time for that final market update. Market's somewhat sluggish today. You can see that the Dow is down just over 88 points currently with that big gap, but seeming to consolidate right now, maybe trying to make that move to the upside. But look at the S&P, did see that big gap down, really tried to take back all those losses, but failed at yesterday's close and looks like it might be turning back over. NASDAQ, though, having a pretty good day. Tech is enjoying a bit of a rally, and the NASDAQ is up almost 22 points. NYSE, very similar look, big move to the downside and now consolidating sideways. TSX, however, looking pretty good here, forming a very short-term flag. It did pull back on its open, but is now making a move to the upside. Russell 2000 small caps down a little over 0.25%. Treasury yields are rising, and currently we have a reading of 2.060%. VIX, was on the rise earlier this morning, but has been pulling back down. We're looking at a reading just above 14. EUP dollar up slightly, consolidating sideways. And we're seeing gold moving to the upside. May have hit its intraday high. We'll have to watch as it consolidates sideways. USO is rallying to the upside. It is up 0.75% right now at $12.02. And then we can see that bonds are down slightly. Currently, TLT is reading at 132.40. Taking a quick peek at our sector summary and sector rotation, like we talked about earlier. Comm services, real estate, consumer discretionary, and technology all leading to the upside. Definitely a mix of those aggressive and defensive sectors. Materials certainly being hurt the most right now, down a little over 1%.
All right, I'm going to pull up the NASDAQ chart. This was actually a chart that I put into my Trading Places blog just a couple of days ago. I think it may have been yesterday. And, when you look at the longer term chart on the NASDAQ, when I say longer term, this is a 60-minute chart. Normally I do a 1 month, but this is a 6-month, 60-minute chart. You can see a beautiful uptrend. And then what I saw was an inverse head and shoulder off this high, left shoulder, neckline, head, right side of the neckline, right shoulder, and then a gap breakout. Notice we came back perfectly, back tested this neckline, and then back off to the races. The importance here is that with this measurement from the neckline at 7,900 down to the low at 7,300, that would be a 600-point measurement. So when you break out above 7,900, that would take us into record high territory at 8,500. But in order to get there, we're going to have to clear that April high, which is at roughly 8165, 8170, something like that. We need to get through there. But if the NASDAQ gets above that level, breaks through 8200, just keep in mind this measurement here does project to about that 8500 level. And I think we're going to go hit it this summer, maybe throughout the earnings season. We'll see. All right, we are going to move now to our final segment, which is Sound Off. For those of you that are unfamiliar with Sound Off, it is a pretty cool segment. I really like it. It gives our experts an opportunity to literally sound off and debate the merits of a topic. And they might agree, they might disagree, but not only are they sounding off, but they only get 60 seconds to respond and to convince you of their argument, or their sound gets turned off. Their sound will be off. So hence sound off. So are you two ready for
I think
this?
my husband wishes he could do that.
All right, I'm not commenting. That'll get me in trouble. Are you both ready? You ready, Mary Ellen?
I am. Yeah, I was kind of hoping there'd be a gong, but I guess we'll do turn the sound off.
All right. Well, I will let everybody know that I did give you all the topics at the, before the show.
You thankfully did, Tom. That was very
Yes.
generous.
Well, you only have a minute. You only have 1 minute. You got to look at least a couple charts. And I know everybody wants to hear your thoughts, after thinking through it. So we're going to start off. First question, and I mentioned this a little bit earlier in the program, that the U.S. dollar strength since 2011 has been weighing on the relative strength of both energy and materials. Both of them have been in an 8-year relative downtrend versus the S&P 500. But if you had to get into one of them right now, energy, the XLE, or materials, the XLB, which would it be? And I'm going to give it to Erin first. And when your chart comes up, the 60 seconds starts.
Whew. Okay, here we go. All right, I've got XLE up here first. I think they're, both sectors not doing so hot, but you can see energy is really starting to perk up. And, we've got the PMO rising here. OBV is confirming this rise. The 20 is just about ready to cross over that 50-day EMA. So I think energy is looking pretty good. And when you look at the XLB on the same setting, look at the difference here. You've got a PMO topping almost down there to getting its sell signal. OBV is flat. And look at the scooter rank really taking a dive. Now, I'm still very bullish on gold, but it doesn't seem to be helping XLB hold up as well as I might think it would.
Okay.
Ooh,
So
I got it all in.
Yes. So your answer is XLE.
It is XLE.
All right, Mary Ellen, you're up. You get to look at your charts. Which one do you think, XLE or XLB?
Okay, let me wait. Did the clock start?
Not until your chart comes up.
Okay, good. All righty.
You
So
can't delay, though, on purpose. You can't sit there and wait 2 minutes to pull your chart up.
okay, we are going to start with energy, and Erin very succinctly covered the sectors. I'm going to drill down. This is WTIC, a look at light crude oil. We can see it's stuck here around 57. We would need to see a break above 60 before energy stocks come to life, but there's too much oversupply. OPEC did cut production today. It did not have an impact at all, and this overglut is expected to continue into 2020. I think energy is going to suffer. I'm going to drill down into the basic materials and take a look at gold, and this has everything to do with the dollar, US interest rates, and there is a speculation that interest rates will be cut. There's a 94% futures are looking at the middle of this month when the Fed has their meeting. Futures are up for. There is an expectation that interest rates will be cut, which of course will again boost the dollar and will be good for gold. So,
Uh-oh.
cut off.
I'm going to guess that you were going
Oh,
to
Tom.
that you were going to go with
Yes.
materials.
You're right.
Okay.
You're absolutely right. I appreciate that, but I don't know if it.
I could tell where you were going with it. I do want to, I'll just throw in my 2 cents, even though no one's asking for it. I would go with energy just because of renewable energy. I really like that area.
Oh, renewable, yeah.
And I think that will help maybe give that energy a little bit more of a boost. But anyway, all right, let's move on to our next subject. And Mary Ellen, I'm going to have you go first this time.
Oh,
But
nuts.
this morning, Square was upgraded, and Square is starting to show relative strength versus its financial administration peers. And then, of course, you got PayPal, which has just been on a roll for quite a while. But if you had to buy one now that Square got the upgrade and starting to show a little strength, which one of those two stocks would you favor? Would it be Square or PayPal?
Okay, so we are looking here at a chart of PayPal, and we can see that the stock has been in an uptrend for quite some time. This is a stock that I'm very familiar with. It's in a very active area, and it has been doing well, which is great. But let's take a look at Square, because as Tom mentioned, and we were talking about this earlier, the stock did get upgraded. The growth prospects for Square are absolutely incredible, and the fact that the stock is finally waking up. I would say from a valuation standpoint, we can see, and actually it is up quite a bit. I would look for a pullback, but this is something I have been waiting for quite some time. This is a consistent outperformer once it gets going. This is very much going to be the catalyst. Look at the volume here. So again, on a pullback, I would be a buyer. RSI, MACD are both positive. I would look for this to finally join the rest of this very vibrant group that it is a part of, and that is the payment processors.
So you go Square.
Square.
Okay. That is a Square kind of answer. All right, let's go over to Erin. Which one, Erin? Square? Or
Hang on, I have to pick myself off the floor because you actually agreed with me on the last one. So give me a second here. Okay. Also, boy, Mary Ellen, I forgot. You can talk so fast. It just doesn't seem fair, but let's go ahead and look. All right, I'm going to start with PayPal. I'm just going to go through what I look at, basically on these. And, PayPal, we're seeing that turn to the upside on the PMO. Looks like we're going to get that crossover. Volume's been, it's been okay. The scooter, though, is showing us that it has a lot of relative strength. And I'm going to look at, let's see, get Square here, and let's make a comparison. Really, it hasn't been performing quite as well as PayPal, but it is making that beautiful breakout. PMO is turning up beautifully. It's not at all overbought. Now we're starting to see some strength there with Square getting in higher on the scooter. And I'm going to try and get the weekly charts up here, but we'll see. This is Square's weekly chart turning up in oversold territory. I think that is a positive for Square. And then if we do PayPal quickly.
Yep, not quick enough.
All right, but I have to. Do I get to say which one? Because everybody is probably with bated breath here. Honestly, I think I would go with Square just because it is starting to make that turn. I think if I were holding PayPal, though, I certainly wouldn't get rid of it just to have Square. So I think PayPal's still looking pretty good.
Yeah, I love both these companies, and especially Square with the break today to the upside and the relative strength the last couple of weeks. I think that it's beginning to show. But Square, and I think you mentioned this earlier when you did upgrades, Erin, $82.50, $83 is going to be an important level for the stock to get through. And if it does get through it, that's when I think this becomes a very, very interesting stock with relative strength behind it. Okay, we're going to move on. And Erin, you get to go first this time. But before we actually look at the charts, I got to ask both of you, which would you prefer to drink, Pepsi or Coke?
Oh, I've been a Coke Classic girl for as long as I can remember, and even when I'm on a diet, I still will drink it. That is my.
I gotta say, yeah, I haven't had a soda in 20 years, maybe. Yeah, it's but these companies are more about not just soda; they're about those energy drinks, and they certainly have a lot of other product diversification. But you asked a question, I'll answer it. Coke.
Wow, I'm impressed right now, actually. I go Coke. I'm going Coke. Although
yeah, I think we're all classic, aren't we?
Yeah. All right. Well, that was fun, but now we're going to go to the charts. So both these companies obviously are very, very good long-term performers. We know who Warren Buffett would pick, but between the two of you, Pepsi and Coke, looking at the charts, which one do you like, Erin?
Wow. This was kind of hard for me, honestly, because I'm really not a fan of either of the charts. PMO is turned down below its signal line on the daily chart. If we go and look at Coke, let me see if I can get over here and get my chart style. No, I can't. So we'll just quickly do the weekly. When you look at the weekly, we are seeing that buy signal and it is moving up. It's not too bad there, but let's look at PEP. Get a little pep in my step. You can see that the PMO is now starting to roll over on the weekly chart. And if I just go over to the daily chart for Pepsi, it's not looking so good on a daily chart either. But if I had to go with one or the other, and it doesn't have anything to do with the fact that I like to drink Coke more, I just looking at this weekly chart, of Pepsi, I have to say that I would be continuing with the Coca-Cola.
Okay. All right. So Erin goes Coke. Mary Ellen, do you agree?
I we'll let you uncover that as we move on. But yes, let's go ahead and get started. So in line with Erin, we're looking at a daily price chart. Pepsi came out with earnings today. They beat on both sales and earnings. What I find disconcerting is the fact that the stock is dropping. It's down 1%. Big volume, not what you want to see when a company beats. So let's go ahead and take a look at Coke. And what I like about Coke, oh, I just revealed it. Take a look at this relative outperformance. It's finding support at an upward trending 10-day simple moving average. Company is due to report in about a week or so, but of the two, as far as a chart, the RSI, MACD is both positive. It's pulling back in line with Pepsi, but again, at that shorter term 10-day, I think the momentum is with Coke.
Okay, so both of you going Coke. One of you to drink it, and both of you to actually invest in it.
Yeah, I won't support the growth, but
Okay.
Yes.
All right,
No,
well,
I can't give it up. I can't give it up.
Okay, I wanted to just show a quick chart on this because a little educational too.
Mhm.
But if you're looking at two symbols, you can put them into the symbol area here and separate them with a colon, and you can see which one is performing versus which. And you can see that Pepsi throughout the first quarter and into the second quarter was outperforming, but over the past 3 months, it's going the other way. Coke has actually been outperforming now. And so for that reason, I think I would go with Coke as well.
Hey, there
All
you
right,
are.
so all three of us went
Oh,
there.
you agree again. Oh my goodness.
Yes. Well, I agreed with your Monday setup yesterday too, RNG, remember?
I know. Maybe I'm convincing you.
Well, I took a fall over the weekend. I think that's what happened.
There you go.
I'm kidding. All right. This morning there was news out that Cisco was buying Acacia for $26 billion in cash. What do you think? Is Cisco a buy? Would you be a buyer of Cisco? Yes or no? And this
Okay.
is Mary Ellen. Mary Ellen first.
alrighty. Let me just get my chart up here. Okay, so we can see this is a daily price chart of Cisco, and oftentimes,
Not seeing your chart yet.
okay, let me go ahead and, that means my time didn't start, by the way.
Well, you have it up. So it's
Okay, no, we're good. Okay, so what we are looking at is a daily price chart. As Tom said, news did come out on the merger activity. Oftentimes when the acquirer, and particularly with these larger companies, oftentimes the stock will drop on the news. Not so with Cisco. It's up not a lot, but a 0.5 percentage point. That I find constructive. Also, we can look at the earnings estimates for the stock. Their analysts are calling for 18% growth this year, 11% next year. The stock holds in really well. We can see these higher lows as the stock continues to advance. RSI is positive, MACD is positive. So, I forgot there's a second stock, but I do like Cisco better. Let's take a quick look at ACIA. We can see that it's up quite a bit today on the buyout news, and I would argue that up 35%. A lot of this buyout news is built into the stock. I would go with Cisco.
okay. Yeah, Erin, Cisco.
Our producer's like, dang it, I want to cut you off.
So I'm coming in right now as the producer, and I think this is too easy for you guys.
Uh-oh.
I'm thinking like 30 seconds maybe, and not this minute.
All right, well, the last one we'll do 30 seconds. How's that? And that will tie right into the poll. And by the way, that's just a quick reminder, everybody, check the poll because we got a question out there about Netflix and Disney. We're all going to chime in. Apparently, we're only going to get 30 seconds to tell you which one we're going to go with. But we want to know what you all would go with. So Netflix versus Disney, check out that poll. But before we get to it, Erin, Cisco, would you buy Cisco?
All right. There's it's really time frame. Did we say that it would be shorter term or through the end of the year?
No, didn't say. Just would you be a buyer? You don't have to buy it.
Well, I'd have to say in the shorter term, I would be a little bit concerned, only because I'm looking at that rising wedge. I don't like it. The good news is, and I agree with Mary Ellen in that, usually when you get the purchaser usually loses quite a bit on it. Cisco did not. I do have a PMO buy signal, so I really can't argue with that. It's still high scooter. So I think that's great. And then, oh goodness, let's go to ACIA. There we are. And yeah, you've got the big move to the upside. I don't, for me, I don't want to chase. That alone would kind of keep me out of it. I do have your relative chart here, though. And of course, Casey's obviously doing pretty well relatively now that it's gotten bought out. And Cisco, if we look at.
Oh, I think she was cut off. I tell you, if you can go back to your annotation, I don't know if you have that, Erin, but this is an example of, in the eye of the beholder when you look at these charts. Because if you annotate that, you were showing a bearish wedge.
Yes.
I was actually looking at an ascending triangle. So if you start with the April high and just drag that straight across, we had a false breakout at that 57 level. And then if you take the lows at the beginning of June, and then again at the beginning of July, you have rising bottoms. I think you got an ascending triangle. So again, it really depends on how you look at these charts. Everybody looks at them differently.
Absolutely. Well, and we have, you and I, because you use candlesticks too, a lot of times our choice of, the trend lines maybe differs sometimes, and the support and resistance sometimes.
Yep. All right. Well, we got to move on. I do want to make one other comment, though, because Mary Ellen brought up the buyout and the fact that buyers, the acquirers, a lot of times will pull back. Normally, as a CPA, this is something I really, it's kind of close to my heart. But Cisco, because they're buying the stock for cash, there's no additional dilution. There's no additional shares being issued. So many times when they buy for cash, they're simply adding earnings with the same number of shares. It's usually accretive. So that's why a lot of times you won't get that pullback with an acquirer when it's for cash. But anyway, all right. I know the producer wants to cut us off. We're going to have 20 seconds. 20 seconds.
20?
Netflix, 20 seconds. We're running out of time.
I guess so.
Netflix versus Cisco, or Netflix versus Disney. Erin, which one?
Okay, in 30 seconds. I don't like Disney, to be perfectly honest. You've got the PMO turning downward. Yes, we do have a nice scooter. And the weekly chart, while it's, doesn't look that bad, you can still see some deceleration coming along on it on the weekly chart. And look at the difference here with Netflix. There we go. We're seeing on the weekly chart, it's turning up, and we're almost there with a buy signal. We've got overhead resistance, but it's, I think, still
too late. I'm going to assume that was Netflix. Mary Ellen, you're up.
Alrighty. Let's take a look here and pull up the chart. What we're looking at is a daily chart at Disney. This gap up is news that they are going streaming. Then the stock gapped up further on news that they are going to be releasing a ton of hit stocks. I've been watching this stock for some time. It's languishing. I don't like that, even though they had Toy Story blockbuster results. So I would take a look at Netflix. They're due to report in about 10 days. It's all about subscribership. They're seeing international growth. Company announced today that they're going to be cutting costs because of a recent flop. And I know analysts are going to like that. I'm going to go with Netflix. I like it's poised to.
All right. Well, you got that in. You're going to go with Netflix. I'm going to take the screen. Go ahead and start me. I can get this in 30 seconds easily. All right, so Netflix, I'm going to say no. Right now, you got a false breakout on a relative basis. Not exactly excited there. Disney, on the other hand, has been trending higher. Great volume trends. Look at the relative strength. I picked Disney. Let's go to the poll and see. Well, we'll get a summary, and then we'll go to the poll, I guess, and see what everybody else went with. But we're running out of time, so if we're going to pull it up, it's going to be quick. Disney, yes. I win, and that's the end of the show.
That's it.
Tom, you win a trip to Disneyland.
Yeah, exactly. That's what I feel like right now. Yeah, I get a trip to Disneyland, but I have to pay for it. All right, well, it was fun. I do want to remind everybody before we go that Chartwise Women, it will be tomorrow starting at 3 o'clock Eastern. That's a new time, 3 o'clock Eastern. Check it out. Really excited for both Mary Ellen and Erin for the show. I want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we will see you back here tomorrow. Happy trading.